Welcome to our weekly Forex and Futures forecast. My name is Jay Norris. I teach trading at Trading University. As always, we need to remind you trading involves risk of loss and is not suitable for all investors. First market we're covering will be the Australian US dollar. Now, no surprise to us, the Aussie dollar does look like on a higher time frame basis you're trying to carve in a longer term bottom here. We see that as the likely outcome to the past couple of months trade here, although you could see you still made a lower low here, so something to watch. I think when you pan out to a higher time frame, that monthly chart, it's easy to start imagining that at some point over the next couple of years that you will carve out a nice bottom in here. So basically that's why we're focusing on that market. Again, just to recap what we said last week, from a fundamental structural standpoint, the Aussie's got a lot of things going for it, or Australia overall has a lot of things going for it, namely a great demographic and really a great position in the global marketplace too. So next market we'll take a look at will be the dollar Swiss, kind of the opposite of the Australia. Switzerland being the opposite of Australia, not the best place in the global marketplace anymore, and I wouldn't even want to speak to those demographics over there. Dollar Swiss, as you can see, the dollar made good headway against the Swiss franc. As we said last week, this is a daily chart, same chart we looked at last week. It was sitting right on support last week. Market responded to that support, so you got higher prices, and that's something that we would look for more of the same on this. Next market we'll take a look at will be the dollar index itself. Same story in the dollar index. The market was on support. It responded to support. You had a really good rally out of there. You can see you're working up towards the top of that range that it's been in for a month or so. Big week ahead because you have retail sales coming out in the U.S. Now, you've had 3 months in a row of lower retail sales, so that's a concern. Granted, it's a concern that's in the rear view mirror right now. You're in the midst of the retail boom right now, the retail spring boom that you generally see in the U.S. economy. Nonetheless, March's retail sales will be important because if you have a lower number, it's going to mark a fourth month in a row of slowdown in retail sales, which is kind of strange for the U.S. economy. So that's why overall that number will be significant. You may have some pretty interesting headlines coming out of there if you don't get that higher than expected number coming out this Tuesday. So that'll be something to watch. I would think if you do get a lower than expected number, then the dollar index would be susceptible to back up again. On the other hand, look, you have pretty good support right at the 96 level. It held once, and we would almost have to anticipate that holding again. So we're still dollar bulls for sure. We think on the long run, you pan out to a monthly chart, that there's still plenty of room on the upside. If you look at where that trend line came from, at one point back in 1983, the dollar index was all the way at 160, right? You won't see it on this chart, but that's basically where it came from. So we still think there's plenty of room on the upside in the dollar index. We're still holding on to our long-term long positions in UUP, the US dollar index ETF. Next market, the euro. If we're still bulled up on the dollar, then we're still bared up on the euro. It really comes down to that. You can see that the euro retraced more than 5/8, more than 2/3 of that little hiccup here. And that this is what passes for a short covering rally in the euro. Not very big at all. So euro is still in a sickly position there overall. If you hit the monthly chart, the euro looks like an icicle hanging off the gutter in early March. What happens is you get a little bit of a warm up and poof, that icicle falls off. And that's the image of the euro right now. Terrible demographics in Europe. They just don't have the continuity of government that I think you need to lead a nation through the challenging times that every nation faces right now. So I think they have that disadvantage of such a disparate region trying to go with the central leadership there. And of course you have probably some of the worst demographics of your major capital markets. So currencies being a relative game, as bad as things look for the euro, the mirror opposite is going to be that the US dollar is going to be the beneficiary of that. You just have much better demographics in the US. You have a much longer history of retail sales, and let's face it, retail sales is 70% of the economy. So Same old story in the euro. We continue to sell rallies there. Gold market, it's a bear market. Pan out to a weekly chart, you'll see that. You can see, I guess, a lot of technicians will call that a pennant right there. No support. So no surprise, the support did hold for now. However, we think as the U.S. economy picks up steam heading further into the spring retail season, that's really going to be the death knell for that support level in the gold. And when this market slices through support around the 1140 level, down will go gold. Last market we'll take a look at will be the 10-year note. There's the 10-year note. That's on a monthly chart, by the way. We think this is a strong possibility this will be your first lower high in the bear market that ensues in the 10-year. But we think that this sea change move in the 10-year note, in the U.S. bond market, in U.S. interest rates overall, will be a more modest turn here. So if anything, longer term, you'll have this chart will give the appearance of going sideways. I think on a shorter time frame, you'll start to see the lower lows and lower highs of a bear market. On the other hand, the big picture, it'll be a gradual sell-off there. My name is Jay Norris. I teach at Trading University. Thank you so much, and we'll see you next week.